Lagari. Today we're going to talk about bond valuation assignment CLO4. So we'll be talking a deep dive into the world of bond valuation, exploring how time values of money and interest rate fluctuations play a critical role in determining their prices. So let's see our today's agenda. Bond valuation, time value of money, interest rate sensitivity, equivalent bond A and bond B prices, analyzing price changes percentages. So let's see bond A versus bond B comparison. Credit rating, par value, coupon rate, everything is same for the bond A and bond B except maturity. So 30 years for the bond A and 5 years for the bond B. So which bond exchanges at a greater price? So it always depends upon the maturity. If the maturity is more, let's see, for the bond A, maturity is like 30 years. So that resulting in higher market prices. For the bond B, maturity is like 5 years. That decreases uh, in the market prices for the bond. So time value of money. So the longer the time until the maturity, the greater the present value of bonds' future cash flow. This is because those cash flows have more time to compound, making them worth more today. And second, interest rate sensitivity. Bonds with longer maturities are more sensitive to changes in interest rate. If rate rises, the present value of those distant cash flow decreases more dramatically. And let's see, investors' perspective of the things are like investors are willing to pay a premium for the longer maturity of bond A because they are essentially buying those future cash flows at a higher present value. Mm. Impact of rising interest rates, impact on bond A. So, bond A, its longer maturity will be more significantly affected by a rise in interest rates. Its prices will fall more sharply due to the greater sensitive of its long-term cash flow. In impact on bond B, with its shorter maturity, will experience a smaller price decline. Its cash flows are less affected by interest rate fluctuations because they are closer to the present. So interest rate 2% increases impact the price changes of bonds with different maturities. We can see the x-axis and y-axis. So the x-axis will indicates the years and the y-axis will indicates the interest rates. And let's see the table, like explaining price changes with numerical examples. So let's see for the bond A and bond B, initial price is like $100,000. And the interest rate change for the two bonds is 2%. The new price is $80,000 for the bond A and $95,000 for the bond B. The percentage change, we can see 20% depth uh, in bond A and 5% for the bond B. So let's assume all bonds have the initial price of $100,000. Now imagine interest rates rise by 2%. Notice how bond A price drops at $80,000 at 20% decrease, while bond B only drops at $95,000, 5% decrease. This clearly demonstrates the greater price sensitivity of the longer maturity bond to interest rate changes. So these figures illustrate why investors must carefully consider maturity when making investments decisions, particularly in an environment where interest rates are expected to fluctuate. So investment strategy during an economic slowdown. So, shorter maturity bonds. So, like if you anticipated an economic slowdown that might lead to lower interest rates, short-term bonds can be a good options that offer less downside risk if rate decline, and they may even offer capital appreciation. And two, high-quality bonds. During economic uncertainty, prioritizing bonds with stronger credit rating minimize the risk of default, which is a greater concern during difficult economic times. And three, diversification. So, as with any investment portfolios, diversification is key. Investment in a variety of bonds with different maturities and credit rating to mitigate risk and improve your overall portfolio performance. So, let's see the conclusion. It's all about for well-informed judgments, grasp bond valuation and investigation techniques. Sorry, investing techniques and important points for most investment: time value of money, interest rates, and bond valuations are essential. Maturity. Stable bonds are short maturity. Longer maturity bonds provide larger yield but are riskier. Strategic approach. To improve returns and risk, modify bond portfolios according to market and economic situations. Call to action. Think on these ideas while making bond investments. So I took the reference from these sites you can see below and from the book.